Joining us now from our Rockwell studio, Phillip Hagedorn, Chief Investment Officer of ADR Asset Management. Good morning, Phil.
Hey,
Thanks for joining us.
Morning, Kathy. Morning, Mimi.
So, Phil, let's talk about the U.S.-China trade deal. You know what they say, the devil is always in the details. And so far, markets in the region seem to be unimpressed. What do you think? Does this deal make the U.S. more attractive now as a destination for investors or markets, emerging markets like the Philippines? Where will funds flow following this deal?
Well, I think if you look at last year, the U.S. markets did very, very well, notwithstanding all the overhang of the trade deal. No? So I think this clears up some concerns that we had last year as far as any escalation of this trade positions of the countries. I think based on your previous guess there, Kathy, I mean, I think we could see emerging markets recover a little bit. Last year, they certainly underperformed developed markets. And I think any sign that there's a lowering of the tensions in the trade space will possibly flow positively to the emerging markets. And I think your previous guest also saved me a lot of time, but he clearly said that the Philippines stands out when you look at emerging markets. So I'm quite optimistic that we should bounce today. Yesterday we closed at the low of the year. It's been only 2 weeks, and we were still struggling to keep our heads above the 7,700 level. But I would expect that we have a positive reaction today.
Yeah, I'm happy that you see it that way, because when you look at the Moody's report, the ending line is that the risk assessment is pretty negative for risk appetites, and in particular the APAC sovereigns. But did he give a nuanced assessment there that the Philippines is least affected? But how are you advising clients, Phil, on both tactical and strategic positions? And what are going to be the drivers for each, given the external risk that we now face are not in control of heading to phase 2?
Well, I think even last year we were saying that, Filipino investors have the opportunity to invest offshore. So having part of your portfolio invested offshore is still a good idea. But we think that the Philippine market it's undervalued today. We felt that the market fair valuation from an index standpoint should have been somewhere around 8,500. The earnings numbers were met this year, or so far, at least for the third quarter. We'll see after February and the fourth quarter results if the full year has been met, but we fully expect earnings growth to be somewhere in the neighborhood of 12%, and that was the expectation. So, I think the market has underperformed our expectations, but we feel that this values will be put forward, and once we get the full year results, we expect. I think the idea is that the emerging market flow happens and the Philippines stands out and some money flows our way.
Philip, if the Philippines stands out, as you say, then why are foreign funds leaving us?
Well, because I think right now there's negative sentiment generally across a couple of things. I think in the last week, honestly, there's a lot of concern about what's gone on with our eruption in Taal and the longer-term effects of this. I think it's created some negative sentiment. It's very strange yesterday, the performance where you saw lots of Asian markets moving, and we're being very tentative and very negative, considering the fundamentals, considering the results, even the macro situation the country's in. I think there were other factors at play, and my sense is it had to do something with this situation we're dealing with.
Mm-hmm. Of course, regulatory risks domestically also said to be affecting investor sentiment. We're now in the 6-month countdown to the new water concession agreements, Philip. Do you think realistically there is a possible win-win option for the private companies?
Well, I think the private companies will be involved in water distribution. And, I think in the end of the day, delivering the service, it's always been an advantage and I think better results when the private sector is responsible versus the government running those projects. So I would fully expect that the private sector be involved. that there's a review of the contracts. The government has that prerogative. And let's see what happens. But I would expect that the private sector would be responsible for water distribution in these areas.
Phil, I wanted to pick up on the Taal disruption. As that plays out, impacting livestock, agriculture, tourism, how do you see invested listed firms in the Calabarzon area impacted relative to their overall exposure in the Philippines? Is there any listed firm that sticks out?
Well, there's a lot. You look at the Calabarzon, it's a big area, right? And I think it depends on the magnitude of the potential eruption. If we've seen the worst, then I don't think we're going to see much impact. Obviously, Taal and Tagaytay in particular is a heavy local tourism zone. Many companies have operations there. SM has all the major property developers have exposure in Tagaytay. And I would expect that tourism will slow down a little bit in that area. And so there could be some minor impact as long as this is the worst we've seen. Now, if it does get worse and if it escalates, then you look at, for example, the Cavite area, the industrial zones there, the ports in Batangas that are important for moving. There's farmland, there's sugarcane land, there's a lot of these agricultural lands that can get affected. So we're just praying that we've seen the worst. And if we have, then we recover and we should be back on track. But I think that's concerning a lot of folks. And, it's made the world headlines. So it's a wait and see at this point.
Okay, Andres still joining us from our Morocco studio, Phillip Hagedorn of ATR Asset Management. Hi, Phillip.
Hey, Mimi.
Hi, Phillip, very quickly, what do you tell investors now? Is it time to buy the blue chips, to focus on blue chips, or to try the second or third liners?
Well, we think there's a lot of value in the large caps right now. The earnings numbers and the strong earnings growth we're seeing is primarily driven by property sector, the banking sector. So I think these two areas are going to be an area where we should be looking at and focused in. Consumer sector underperformed a little bit last year, but we expect margins to improve there. So we think the consumer sector would be an area to invest in as well. From a non-index standpoint, I think the industrials, particularly the construction companies, the construction materials, again, is an area where we're positive on, and we think people should put money in.
Going now to 2 to 3 weeks from now would be the central bank's first policy meeting for the year. That is February 6th. What are you expecting from the central bank? A move or no move, and further cuts there in reserve requirement ratios? Yesterday, the Central Bank of China actually injected $58 billion fresh liquidity into their system. What about the BSP?
Yeah, we expect the BSP to cut 25 bips. I think over the last few weeks, the messaging has been that. The feeling has been maybe we're moving too aggressively, but we fully expect that Governor Jokno will implement the 25 basis point cut. The question, I guess, is on the second one, because in the beginning of the year, we felt 50 bips was in line this year, but right now we're thinking we'll see the 25 and wait and see if the second cut will happen.
Okay, Phillip, you've been in this business for so long. Actually, ATR Asset Management is celebrating its 10th anniversary. Congratulations on that. I guess my question is, when you look at the big picture, Phillip, where are we in the cycle? They say some say it's a 7, some say it's a 10-year cycle for markets. Where are we?
Well, to be honest, Mimi, we've been at 7,600 since 2014 or 15. So I think we've been in a 5-year consolidation with a very wide band, where the peak of that band was 9,100, the bottom of the band around 6,500. And we bounced around that band for 4 or 5 years. Could this be the breakout year? Could this year be the year that we start looking at that double-digit thousand number of 10,000. For me, the bottom line is the earnings have to be the driver of this. And 2019 was the first year that, first year in 5 actually, that the double-digit earnings growth has hit as an average. Second, we're expecting that sustained momentum carries on at least for 2020. And this puts the market in a very good value standpoint, 15, 16 times multiple, when the peak was 21, 22. Sentiment has been negative, and that sentiment needs to change. And I think the key for that would be, number one, confirmation that our fundamentals are in place, and the settling down of sort of the rhetoric globally that has weighed on a lot of markets. I look forward for the emerging markets to take a bit of a front seat this year. And if that happens, then the Philippines will likely take a front row in that front seat. And we should see much better performance.